Wow. What an amazing year, huh? Listen, we're going to go through some numbers. I got Price Rayner with me today. We're going to go through some of the numbers of what we've seen in the past, kind of historically speaking on typically what we would see possibly going forward. Give an idea of where the market is, hopefully answer some questions for you about where we may be headed and some of the statistics looking back over the last 20 years of what's setting the table for what we believe is the possibility to see an amazing year in 2021. Let's get to it. Well, Price, this is pretty interesting. Listen, we're going to be probably pretty excited as we start reviewing some of these numbers. I don't want to discount. I don't want anyone to take this the wrong way. With all of the suffering that's gone on, we've had it in our personal families, but we want to talk specifically about what's happening in this region, what we're seeing in the real estate market, which has just never been seen before. But
so we just want to set the table to say that we don't know everything, but based on some certain variables that have played themselves out over the last 4 years and what we believe we're going to see going forward, we're going to have this talk today. So understand that this thing could change on a dime. There are macro events and things that happen in cycles. So we're not looking for perfection here, nor are we trying to lead you in a particular way. We just want to share what we believe, what we know has happened, and what we believe will happen based on what we're looking at. And we have a couple models that we'll talk to you about in this video that kind of point us in that direction too.
Here we go. We have become the old guys with over 50 years experience. It's not that, like Price said, that we have all the answers, but we're operating from a place of experience.
Yes.
One thing we do know is that to think that things will not change would be naive. And so we're going to go through to give you an idea based on the past of what we anticipate some of those changes may be. So let's get right to it. Let's kind of go in here and start talking about some of the things that we've seen literally year over year, 2019 to 2020. Can you speak to those numbers?
Sure, happy to. Thank you, Jimmy. Yeah, in 2019, along 30A, the area that we're talking about today is south of Highway 98 from one end of 30A to the other. Just to kind of set that for you so you know exactly what we're talking about. And we're talking about the numbers we'll use. We're talking about detached single family homes. That's kind of the driver of our market and what we'll focus on in today's talk. So in 2019, in that area, we sold 1,074 homes. In 2020, we sold 1,709. That was an increase of almost 60%, 59.12 to be specific. That's a huge jump.
Incredible.
The most we've seen in the 20 years we've been tracking this, year over year. The average price increase of those homes from 2019 was $1,165,000 compared to in 2020 it was $1,408,000 and change, an increase of 27.16%. Another strong jump year over year.
Let me mention that because when we're looking at this average price and you see 27%, there's some factors in there, and that's why we're going to get to the average price per square foot. But when we're looking at this in reality, we're looking at some numbers that maybe were factored in because of the amount of Gulfront. We never saw the amount of Gulfront homes and higher end properties. So that number's probably skewed a little bit. So let's get to the average price per square foot, which is a little more indicative.
Sure. And the price per square foot in 2019 was $432.92. In 2020 was $502.08. So we saw an increase there of 15.98%, basically a 16% increase year over year on the price per square foot. And I think that will be more consistent, community in, community out, area over area along 30A is kind of a better indication as to how much the market's moved up.
Still substantial though. I mean, this is a substantial move. We're looking at that roughly 16% there. What are the other things that you're typically watching to see?
Well, we like to watch, cumulative days on the market. That's an indication, a very good indicator of demand, where in 2019, it took 150 days on average for those 1,074 homes to sell. In 2020, it was 141 days for that 1,709 homes to sell. So that, is showing an increase in demand. And just to give you a little bit about what's happened in 2021, so far the 157 sales that we've sold through the beginning of January, we're down to 113 days on the market. So we're seeing demand really increase in a significant way.
Let me speak to that if you don't mind, because in reality, when you're seeing the cumulative days on market go down, it's a very big factor on the fact that the amount of inventory that's available and the amount of demand that's there, as those days go down, is telling us that we still have buyers and sellers agreeing on price, and that we're actually seeing those houses sell faster, which is a healthy trend that we want to see. As we begin to see that change and begin to go up on the average days on market, it's telling us that there begins to be a separation between what buyers are willing to pay and what sellers are willing to sell. So very healthy right now. We're driving, typically as you're seeing days on market drive down, you're seeing prices like we're seeing now drive up. Let's talk a little bit about a median price. This is something historically that we have really watched closely. Can you speak to that?
Yeah, sure. And what we have there, on average, when we go back and begin to look at how we determine the median price increase, we look back to an old appraisal group called the Hutchison Group from the 80s. They deem that beach-oriented property appreciates on average each year 6 to 8%. So we've gone back and looked at the last 20 years and drilled down on that a little further to come to a 5.46 annual appreciation rate, or median increase. So when we look at that, we've gone all the way back to 1993 and moved that forward. But in particular, looking from 2000 to now, we took the average price in 2000 of $426,000 per home and just kind of moved that forward. So we get to 2019 where the median price is $1,170,000. And so that's very close to the average price. That would tell me we're in a very, very healthy place. We're right on that median price. Now, when we look at 2020, we see the median price is $1,223,000 and change, whereas the average price is $1,408,000. So we're starting to deviate from that mean. We're starting to see the average price moving higher. So that's going to be something we're going to watch very closely as we go forward.
All right, let's talk about the expansion of the market, because in reality, we're looking at the increase in the number of transactions, but we're also looking at the dollar volume, which shows kind of an expansion of the market. What are we seeing numbers-wise as far as the total volume for year over year?
Yeah, it's about 100%.
It's crazy.
Our market has doubled in size year over year, where the total market of just 30A homes along 30A in 2019 was $2.5 billion. 2020 was a tick over $5 billion.
Yeah, these are both sides. That's your buyer and your seller side. So you're literally from where we are right here in Watercolor with bicycle ride either direction. We're talking about $5 billion worth of buyers and sellers closings. It's amazing to see how this market has expanded over these years. All right, let's get into a couple of other things. Now let's go to this chart, and this is a chart from 2000 to 2020 where we're going to go through and we're going to talk about what is the market changes, what have they been since that time period, and if you don't mind, speak to this.
Sure. And when we look at the chart, we see that back in 2000 the market starts to move and ramp up as we go through 2001, 2002. You can look at the number of sales and the average price, both of those, and the per square foot price. All that's moving up, getting stronger and stronger. We get to 2004 where we peak out in the number of sales. We sold 622 homes there, which was a 61% increase year over year. That's not too far off from our 2020 move of 59% increase from 19 to 20. So we see a kind of a similarity there. But in 2020, we see an average price of $891,000, where in 2020 it's $1,408,000. So we've changed, dramatically, about a 70% increase in price, between those 16 years.
Yeah.
So that's a very nice run there. And then we see from 2006, where we have only 168 homes sell. And our pricing peaks out there at $1,306,000. So pay attention to what happened there between 2004 and 2006. We see where the number of transactions start to decrease from 5 to 6, but yet pricing continues to move up there. And then we get to 2007 where the number of transactions start to increase again, but price starts to fall. And then we see the price continue to fall until 2009, where it bottoms at about $678,000. But there we're up to 370 transactions. So we go from there, from 2010, 11, 12, moving up, where we see there pricing continuing to kind of stay steady but inch up over those 4 years. The number of transactions increase each year, year over year. Then we continue to see the number of transactions increase going forward. Pricing's continuing to move up at a nice healthy clip there. And then we get to 2018 and 19, where we see the number of, really 17, 18, and 19, where the number of transactions starts to flatten. And then we see the average price barely increase on 18, less than 1%. And then it falls in 2019, a decrease of 4.82%. And then we move from there into what is this quite expansive period in 2020, almost in a period of hyper appreciation, where we see, the 59% increase in the number of sales, the 27% increase in the average price, and the almost 16% in per square foot price. So this really gives us a great chart as to looking back over the last 20 years, because quite a bit what we're going to talk about is a book called The Secrets of Real Estate and Banking from Philip Anderson, who talks about an 18-year cycle. We're going to go from this point and kind of take his theory or hypothesis and apply that to our market.
Let me mention a couple of things that you mentioned and you just flew by that I want to sit on a little bit, because these are things that we like to watch. One of them is, if we're looking at these transaction numbers, we saw, and this is almost something we watch, if you're looking here, we saw in 2005 to 2006, we saw the decrease in the number of transactions. We are not seeing that right now.
No.
And so that was something where we continue to see a follow through with pricing going up. So this is something we're watching as a tell potentially, that where we begin to see a separation between what sellers are willing to sell for and buyers are willing to pay. The transaction numbers, historically speaking, will begin to come down, but pricing will continue to go up. So it's one of those to watch.
Yes, if I could just kind of, again, based on the 18-year model by Mr. Anderson and looking at that, if we say that here, looking at this, we say 2009 as our bottom in pricing, and we take, 2009 the bottom of pricing, and 2006 the bottom of transactions, and we add 18 years to both of those. That might put us at 2024, where we start to see this separation you talk about, where we have falling number of transactions, and then maybe a couple years after that where we see a bottom in pricing. Now granted, we're talking about 2004 to 2006, which the market action at that period is 180 degrees different than what we see now. And just to illuminate that a little bit, during that period we saw so much flipping. Very few buyers had a true end use for the property. Their purpose of buying it was to flip it to someone else. The concept of, I hate to use it, but the bigger fool. I'm going to buy this and sell it to someone for more than I paid for it. Whereas where we've seen now from 2010 to 2020, present day 21, is our buyer has been very financially solid, if you will. They're buying with a purpose to have this because I want to be here. I want this for generations to come. I want my family, my children, my grandchildren, my friends, whatever that is, to come here, visit me, use this property. So they have much more of an end user mindset compared to then where it was an investor, flipper, speculation, or the items that were driving the market at that point in time. So vastly different. Please make sure you hear that.
Yeah, and I'll go into that a little bit also, if you don't mind. One of the things that, because we were there in the middle of that, it was like as the market heated up, the lending policies, they became softer. And one thing that we're seeing right now is that actually as this market continues to heat up, the lending policies are actually getting tighter. I mean, we have dealt with issues to get loans right now that I haven't seen since 2006, 7, and 8, as far as the lenders tightening down on what they're doing, which is very healthy.
Yes, it is.
It is a tempering, so to speak, of the market instead of a gas on the fire that we had in 2004 and 5. So that's pretty healthy. Also looking back, if we go back to 2010, 11, 12, 13, 14, we were well over 50% of the transactions being cash.
Yes.
We've never had a foundation in our market that we have now. Cash doesn't panic. Not if, when, the market begins to cool down again. So one last thing I want to mention. If we're looking at this really from 2017 pricing to 2020, we had a flat year, basically 0.36% up, and a down year of 4.82%. The 27%, when you discount that, we're looking at basically a 4 year time period where we literally only saw 23%. So when you annualize that out, it's almost like it is adapting to that. It's picking up the pace that it had lost there for a little bit, and we're going to see that on the chart.
Yes, that's you're absolutely right, Jimmy. And I think it's back to the average price wants to come back to the mean.
That's it.
That's what it wants to do. If we look in 2019, it pulled itself back to become right in line with the mean at 1165 to 1170.
Yeah.
So I mean, we are in a very healthy situation, as Jimmy so eloquently put it just a second ago.
Let's go to this. Let's go in a historically typical thing, and it's been amazing as you and I have done this now for the last 4 or 5 years when you first really began to really dive into this 18-year cycle, how we did not see a bear trap coming.
No.
We did not see acceleration coming. I remember when we talked this very chart last year, we were like, I don't know how this possibly we see an acceleration, and then we get the pandemic and we see what we saw. So let's talk about, historically speaking, what that typically looks like right now.
Sure, and typically it's an 18-year cycle, which within that 18-year cycle, we have 14 years of expansion and 4 years of contraction. That's happened going back to the 1800s. Every 18 years, notwithstanding twice, in both cases, it was interrupted by war.
Right.
So without a macro event, this thing has repeated itself time after time. Right. And what we see there, looking at this little chart there, is we see the takeoff period. Call that 2009 or 10. And we see the market begin to move in an upward fashion, and then it moves up to the bear trap, which we saw in 18 and 19, kind of moving through that period there, that flat part of the curve. Then we see it begin to accelerate there, which we've experienced in 2020, where we had that 27.16 average price increase. So we're moving up that period, and knowing that they call this the mania phase, or the period of enthusiasm. We'll call it a really good growth period there, and that's what we're seeing now is we're moving up through that curve. And if we continue to see the limited inventory that we have right now, we have about 1 month of inventory that's on the market. Granted, so much stuff's being sold off market right now. That's a topic for another conversation. But we have about a month worth of inventory, very strong. So we should continue to see upward movement in price. If we just take a basic economic formula of supply going down, demand staying flat or increasing, which I believe it's increasing, that says price is going to continue to go up if we just take it down to its simplest form.
I agree. And so based on this, if we were looking at this, I mean, the numbers lay pretty standard. Yeah. So this thing is pretty much laying right out here. Now, again, there's always variations. There's always factors. So let's talk about some of those factors and what do we look at?
Yeah, tick-tock goes the clock.
That's right. Every single time.
Yeah, I mean, it doesn't stop. Real estate is cyclical. Therefore, it operates on a clock. It's not straight up into the stratosphere. It has boom and bust cycles. So we have to be cognizant of what time it is. And that's where we begin to look at these variables that we've talked about and what we'll highlight here.
Yeah, and so what we're going to do, really, if we're looking at this, so where are we in that phase? And we're going to take a look at this to get us a better feel, because this is, if you want to explain this a little bit, this is going back to 2000 through 2020 and where we anticipate 2021.
Yes. And what we have here on this chart is the green line is that mean line or median line that shows us that 5.46 appreciation rate each year from 2020 or 2000 to 2020, excuse me. And the blue line is the average price line. It charted out the average price, so we can see that move up starting in 2002, where it goes up very quickly to 2003, 4, 5, 6. It peaks out and then begins its fall thereafter. The bust. It shows the boom and then the bust, and then we see the periods after that where if we we'll recall the chart from before, from takeoff and then moving up, we see where the market has moved up in a smooth fashion, staying very close to the mean, and then beginning to gradually deviate to where we hit that bear trap or that softening period of 2018 and 19, where pricing reversed back to the mean. And then now we see that bounce going up 2020 and thereafter, as it's beginning to really, create some separation from that mean line.
So now let's look at this from a market standpoint. Let's get really granular on, okay, if you're a buyer, what does this look like, and what should you be watching, and what should you be thinking about, and a seller's perspective. Let's start with buyers.
Yeah, sure. And buyers, buyers right now, they're eager for inventory.
That's correct.
I mean, that's it. I mean, they're just starved for inventory.
Right. And then this is the situation, which is that supply is continuing to be restricted, demand, because that buyer inventory is looking there. Now let's go to sellers. What are sellers? What's the mindset of a seller right now?
Seller wants a premium
Then
right now, and they're getting it. Boy, are they getting it.
Absolutely, yeah. And so this is where we're at right now as far as the state of each of these. Let's speak specifically to some of the things that a typical buyer would be looking at, what they should be considering, where does this make sense, and then from the seller's perspective.
It's important right now to listen to the market. We talked about these other factors, and we want to listen, and we're listening to what buyers want, what sellers want, and what we're hearing from our agents. Those are three other factors, because real estate's local, and we have this cycle that repeats itself globally. So we take all this into consideration, and then we boil it down to our local market to make sure everything checks out. And those things that we're hearing from both buyer, seller, and agent are all things that help us to confirm that we're on track with this model, that things are shaking out, as is described there. So now to go back up and say, a buyer, what should a buyer be thinking about right now? Well, if you're looking to get in the market, this is a great time to do so. We have interest rates that are so low, and it's just a great time to be in the market. The trick is finding the place that works for you. So it's important, to have an agent that is working hard to uncover opportunities, whether it's searching for listings, whether it's working with a network of other agents to find those opportunities to put in front of the buyer. Yeah. And buyer, you need to be ready to move as those opportunities present themselves. They're not lasting long, as we talked about earlier, with that decrease in days on market. We believe that's going to continue to decrease. You have to be opportunistic. When that opportunity is there, we got to move.
Brings up a good point. This is why agents are so valuable, because we're seeing inventory continue to go down every week, but we're continuing to see transactions happen. And here's what the difference is. The agents that have relationship with other agents, the agents that are out there making phone calls, that are working with their past buyers, the people that are actually doing the work to uncover properties that are shadow inventory or not. If you're a buyer and you're waiting on the perfect house to come on the market and compete with 8 other offers, it's probably going to be a losing game. So that's why it's critically important to find the right agent, to be working with those folks. This is why as agents it's critically important to be out there working those networks and those relationships that you have already. From the seller's perspective, here's the thing that I would say is, if you want to sell into strength, I've been doing this 27 years. I've never seen an opportunity for a seller to sell into strength. It also is the opportunity that, as we went through everything this last year, and some of our owners in this area spent more time here, it really uncovered some things of, wow, we could really use that extra bedroom. Wow, we could really use that pool, or whatever it was. Most of the people that are selling in our market are not leaving the market, they're repositioning. What an amazing time right now, as we're recording this, tax-wise, to be able to sell your existing property, take that equity in a 1031 exchange, roll it into your ideal property with historically low rates. And in a lot of cases, I know I had somebody that we did this for back a couple of months ago, the payment was not that dramatically different, and the income that they had from their rents exceeded it. So they actually got into a better investment position by repositioning with 0 at this time tax consequences. So from the seller's perspective, you've got more options than we've ever had. This goes back to the reason why the days on market are going is because buyers and sellers are still agreeing on price at this point. So as much as it sounds like this is a buyer's market or a seller's market, there's still opportunities for buyers in this market.
Yes.
All right, let's go back and let's talk about this deviation a little more. Are we now at a situation, because we've been seeing it this year, where you can work from anywhere? And if you have that ability to work from anywhere, then that could be what we're seeing the front end of a migration to where I want to live, which makes us extremely attractive. I think that's what's been driving a lot of this. So does that continue? I mean, if we see that trend continue, that could be another Goldilocks scenario. So let's talk about what we're watching that could be, we talked about the Goldilocks scenario where this growth continues in a pattern that deviates. What are the things we're watching to see about a potential softening?
Yeah, sure. I mean, we're watching pricing moving up too fast. Not really sure what that is, but we'll be watching that curve to see if it continues to steepen and when buyers begin to resist that and days on market start to creep up. That's going to be a pretty significant tell that we could be moving towards a softening. An additional point would be interest rates. Right now they're at historic lows, and the Fed has indicated that they want to keep their interest rates low. So we'll be watching treasuries and that sort of thing as the economy begins to shift from where we are now in the pandemic to hopefully a post-pandemic situation, and see what does inflation and those things have to do with interest rates. That's something where it may be some time from now, but that's something we're going to keep a close eye on.
Yeah, and I think there's been some macro events also. If you can speak to that, when have there been deviations where the macro events made those things change?
War is 2 points that have interrupted this 18-year cycle before. And I think also you have to look for serious stock market pullbacks and other geopolitical style things that could cause a pause.
Yeah, I agree. All this said, Price, I know you and I've been here our whole lives. We've been doing this now combined well over 50 years in this real estate market here. I've never been more excited than I am about where we are, what the opportunities are for both sides, sellers and buyers, than they are right now, and for what does the future hold. So listen, I just want to encourage you guys, if you've got additional questions, reach out to Price, reach out to me. Anything we can do to help. Now more than ever, I think having a resource in the area that can give you up to the minute understanding of what's going on is now more valuable than it's ever been. Take care, and we'll talk to you soon. Thanks for watching the video. I specifically chose the video below for you because it builds on the one you just watched. I hope it's helpful, and I'll talk to you soon.